Well, Fed Vice Chair for Supervision Michael Barr names commercial real estate loans a big risk for regulators. He says, quote, the reduced demand for office space and higher interest rates have put pressure on some CRE valuations, particularly in the office sector.
The world hasn't changed since the pandemic that shook the globe as several countries, including the United States, were affected. While battling a couple of issues since the pandemic, one that sent tremors throughout everyone is commercial real estate, which has spread to other sectors, even threatening to escalate into a full financial earthquake as the trouble looms. So are we in for a crash indeed? You would be thinking that right now, I believe. Don't worry. I'll take you through everything you need to know about this serious issue, including the forecast of many renowned investors. Yes, the commercial real estate market has been in turmoil since the start of the pandemic, and investors remain concerned about the fallout from the slumping value of office buildings and other properties worldwide. This sector has been under intense global pressure as interest rates have risen over the past few years. In the United States, with the largest commercial property market in the world, prices have tumbled by 11% since the Federal Reserve started raising interest rates in March 2022, erasing the gains of the preceding 2 years. Higher borrowing costs tend to dampen commercial property prices directly by making investments in the sector more expensive and indirectly by slowing economic activity and reducing the demand for such properties. Nevertheless, the sharp price decline during the current U.S. monetary policy tightening cycle is striking. About $1.5 trillion in commercial mortgage debt is due by the end of 2025. Still, steeper borrowing costs, tighter credit conditions, and a decline in property values brought on by remote work have increased the risk of default. Check what Yahoo Finance has for us here.
And what's going on here is there is about $929 billion in CRE loans that are set to expire this year. And that comes from the Mortgage Bankers Association. The unique thing there is that is 28% higher than what they initially had forecasted.
The Federal Reserve raised interest rates to the highest level since 2001 in response to sky-high inflation. Rates are poised to remain elevated for some time, as policymakers have signaled they are not prepared to start reducing rates until they are more confident that inflation has returned to 2%. Complicating the matter is that small and regional banks are the biggest source of credit for the $20 trillion commercial real estate market, holding about 70% of the sector's outstanding debt. Listen into this.
Small banks account for 70% of all outstanding commercial real estate loans.
What's more, regional banks are now at the epicenter of the upheaval within the financial sector since the collapse of Silicon Valley Bank. Several banks learned lessons from this, and lending standards are now more restrictive, making it difficult for businesses or households to get loans. Borrowers now have to agree to more stringent terms like high interest rates as banks try to reduce the financial risk on their end. Why is everyone so worried? Those fears were reignited earlier this month when New York Community Bancorp flashed a fresh warning sign, which rattled markets. Here is what Bloomberg reported.
Yes, so it was surprising across the board on a number of different fronts. The dividend was cut to 5 cents a share. They are talking about not growing the balance sheet this year from the loan standpoint, and have targets for capital and liquidity that were a surprise to the streets. And then on top of all of that, there were some credit quality concerns with some losses in the portfolio with respect to multifamily and office lending.
The bank slashed its dividend and set aside more money than expected for losses on bad real estate loans. The firm revealed an unexpected quarterly loss on real estate loans tied to office and apartment buildings, with its shares losing about half their value. In case you don't know, NYCB is the parent company of Flagstar Bank, one of America's biggest regional lenders with 420 branches, and the second largest lender to the multifamily property space. You now have an idea of how large this company is. Surprisingly, it incurred a $260 million net loss in the fourth quarter of 2023 after posting $199 million in net income the previous quarter. This clip shed more light on that.
But the company said total revenue was also well below expectations, came in at $886 million, well below that estimate of $935.9 million. And total net interest income for the quarter came in at $740 million. And net charge-offs swelled to $180 million from $24 million in the quarter before. That was a huge, huge number jump, right?
Aside from that, the firm set aside $552 million to cover loan losses, a huge jump from $62 million in the third quarter. Net charge-offs, or debts unlikely to be recovered, totaled $185 million, compared to $24 million in the third quarter, largely due to a co-op and office loans. Moreover, it slashed its dividend from 17 cents to 5 cents to build up capital. The bank's efforts to clean up its finances stemmed partly from crossing $100 billion in assets following 2 acquisitions in the past 18 months. It bought deposits and some loans from Signature Bank, which collapsed last spring along with Silicon Valley Bank and Silvergate. Is that an indication that NYCB is joining the league? Here is a video of when the Federal Deposit Insurance Corporation took over Silicon Valley Bank.
The new concerns following the collapse of the 16th largest bank in the U.S., Silicon Valley Bank, experiencing a bank run, a stock price plunge, and a government-ordered takeover on Friday, all of it happening fast.
Silicon Valley Bank was a lender to some of the biggest names in the technology world. Still, it shocked the world when it became the largest bank to fail since the 2008 financial crisis. According to their website, Silicon Valley Bank provided banking services to over 2,500 venture capital firms and nearly half the country's venture capital-backed technology and life science companies. For decades, flush with cash from high-flying startups, Silicon Valley Bank did what most of its rivals do by keeping a small chunk of its cash deposits and using the rest to buy long-term debt like treasury bonds. Those investments promised steady, modest returns when interest rates remained low. But they turned out to be short-sighted. The bank didn't consider what was happening in the broader economy, which was overheated after more than a year of pandemic stimulus. By the time it overheated, Silicon Valley was left in the lurch due to the Federal Reserve looking to combat rapid inflation, and they started raising interest rates. Those once safe investments looked less attractive as newer government bonds sparked more interest. Silicon Valley Bank didn't meet its end only because of rising interest rates, but due to its uniqueness, which you will find amusing. Silicon Valley Bank started to see trouble when startup funding began to dwindle, leading its clients, a mixture of technology startups and their executives, to tap their accounts more. The bank also had many big, uninsured depositors, investors who tend to withdraw their money during signs of turbulence. The bank had to sell some of its investments at a steep discount to fulfill customer requests. Once Silicon Valley revealed its huge loss, the tech industry panicked and startups rushed to pull out their money, resulting in a bank run.
The investors completely freaked out, sold off the stock, and then a bank run started where people tried to withdraw $42 billion in deposits just in that one day. And by Friday morning, it was seized by regulators.
But 2 days after Silicon Valley Bank collapse, regulators abruptly shut down Signature Bank to prevent a broader banking system crisis. The bank's swift closures sent shockwaves through the tech industry, Washington, and Wall Street. So if this could happen to banks like SVB and Signature, how much more NYCB? Let me know your predictions in the comments section. Experts' opinion, diverse view. According to some experts, this looming crisis will surpass the challenges experienced during the 2008 financial turmoil. However, some didn't think that way. One such person is the current Treasury Secretary Janet Yellen, who said the banking turmoil over the last year is just behavioral and doesn't pose a risk to the wider financial statement. Here is her comment on the banking system and economy at large.
So I've not really seen evidence at this stage suggesting a contraction in credit although that is a possibility. I believe our banking system remains strong and resilient. It has solid capital and liquidity, and the U.S. economy is obviously performing exceptionally well.
But Komal Kumar, the president of Kumar Global Strategies, challenged this view, saying it's a bigger risk and not limited to regional banks alone. He even mentioned that this ongoing crisis will force the Fed to cut rates as early as May after 4 consecutive times without a cut. During his interview on CNBC Squawk Box, he called the crisis a commercial real estate tsunami.
So you have, I think, what I call a CRE tsunami that is coming.
You might wonder how he predicted that it would likely be May. Lessons from the 2008 crisis show that the Fed should cut it sooner to avoid the worst pain. This is what happened in 2008, allowing Lehman Brothers to go bankrupt. The former chairman of the Securities and Exchange Commission, Jay Clayton, also joined CNBC's Squawk Box to offer his insights into the current state of the commercial real estate sector, its potential repercussions on banks, and the overall economy. Clayton began by addressing the stress in the commercial real estate sector, particularly highlighting the recent turbulence faced by New York Community Bancorp. According to Clayton, this situation exemplifies the broader challenges within the commercial real estate market, especially concerning exposure to travel and commercial properties. Listen to his clip.
How concerned should the market be about banks, broadly speaking, this bank in particular?
Okay. Going back to market regulation to avoid systemic risk. Look at it in 3 ways. Sort of broad systemic risk, the FSOC, the Financial Stability Oversight Council, is the difficulty in commercial real estate going to transmit to the rest of the economy, circa 2008?
Analysts at Morgan Stanley have raised concerns about the industry, citing recent loan defaults by prominent office landlords and a decline in demand for office spaces as warning signs. Additionally, the situation is becoming increasingly precarious, with many commercial mortgages due for refinancing in the coming years. The chief investment officer of Morgan Stanley, Lisa Shallett, warned about the commercial real estate lending rates. Let's listen to her.
While the Fed wants to be tight and wants to, quote unquote, stay on hold, I just don't see any way that they can move towards cutting with financial conditions where they are.
Even if interest rates remain stable, new lending rates for commercial real estate are expected to be considerably higher than existing mortgage rates. This prediction can potentially impact many banks, with an estimated 190 facing challenges similar to those experienced by Silicon Valley Bank. Small and medium-sized banks comprise a substantial portion of CRE lending and are particularly vulnerable. Decreasing demand and vacant offices. Even before the collapse of Silicon Valley Bank and Signature Bank, the commercial real estate market was already grappling with multiple challenges. The rise of remote work has decreased demand for office spaces, further exacerbated by escalating maintenance costs and interest rates. According to Morgan Stanley analysts, there is a potential for a decline in commercial property prices by up to 40%, rivaling the magnitude of the 2008 financial crisis. The commercial real estate sector encompasses many assets, including office buildings, shopping centers, multifamily apartments, hotels, and data centers. However, not all segments face the same vulnerabilities. Data centers and industrial buildings that support e-commerce have shown relative resilience. On the other hand, the office space sector remains a major concern, undergoing a transformative shift that presents significant challenges. Higher interest rates and tighter financial conditions have discouraged lenders from financing risky commercial real estate loans, or have made lenders only willing to do so at higher borrowing costs. Some borrowers could see their interest costs double after refinancing their matured loans, potentially sparking a wave of defaults or delinquencies. Fed rate cuts could easily disappoint investors, and firms aren't raising nearly enough money to buy the total amount of commercial real estate debt approaching maturity. Veteran investor Kyle Buss also warned that the collapse in office building prices alone could cost $250 billion, thanks to commercial real estate troubles and plunging demand for office buildings. Hear him out.
So it's really, I see it as office, and I think the banks in the U.S. will lose $250 billion in office over time here, and there's about $2 trillion of equity in the banks.
The signs of impending commercial real estate trouble just keep growing. Bloomberg also reported that more than $900 billion, or 20% plus of the total debt owed on U.S. commercial and multifamily real estate, will mature this year. Borrowers may have to refinance at much higher interest rates or sell their properties at a big discount. Here is the news.
But now we're at a tipping point, which John mentioned. There's $1.4 trillion of commercial real estate debt coming due in the next 18 months. And a lot of banks and lenders and owners have to decide exactly what to do and where values.
That's everywhere. As I've said, the United States isn't the only one battling this crisis. Property jitters are being felt in Europe too. The value of bonds for Germany's Pfandbriefbank tumbled this month as investors fretted about its exposure to the embattled industry. Moreover, sources told Bloomberg that the European Central Bank has threatened to impose steeper capital requirements on lenders unless they take commercial real estate risks seriously. At the same time, some Chinese investors are rushing to sell foreign real estate at discounts of 45% or more to free up cash as they weather a worsening property crisis at home. Prospective losses, refinancing woes, international contagion, and panic selling combine to create a bleak outlook for the commercial property sector. Can we ever sail through this turbulent storm? I'll be waiting for your opinions in the comments section. If you enjoyed this video, like, share, and subscribe to this channel for more. Check out my next video.